The only reason why you're still not profitable is because you're overcomplicating your trading. Now, for the last 10 or 15 videos, I've been telling you guys keep your strategy simple, and I've only been following these two simple steps to frame my trades. It is extremely easy. You do not need market maker models. You do not need complicated stuff. It all really comes down to these few things that I'm going to teach you in this video, and my goal here is to teach you this same thing again and again so you guys can learn this properly. All right, so it all really comes down to high time frame fair value gaps, right? And then of course the higher time frame order flow, which means the higher time frame trend. Is it bullish? Is it bearish? And then pretty much our entry model that I'm going to teach you in detail in this video. All right, and of course lower time frame entry model, that's what I'm talking about right now. And I specifically trade NQ. All right, and this is the exact model that I use during live streaming, and today we had a winner, just got like 1 to 2 simple trade. I'm going to break that trade down as well for you guys. I'm also going to give you multiple examples so you guys can understand. But yeah, just stop overcomplicating your trading and stop watching all these videos on YouTube. Just stick to one model, backtest it and see if you find results. And then yeah, pretty much just practice, journal, whatever you can do. Because trading is the hardest way to make easy money. If you can understand that this is literally all you need, you're gonna like make your life easy. All right, you do not, as I said before, you do not need complicated stuff. You do not need standard deviation. You do not need quarterly theory. You do not need any of that. All right, so here is my entire strategy that I use, and I've taught this exact strategy in my previous videos. I'm going to do it again. So make sure you guys watch carefully. Do not skip any part of this video because I'm going to drop a lot of secret sauce in this video. And throughout the video, I'm going to drop secret sauce. So if you miss it, then it's going to make trouble for you. So my timing window, right? So when do I trade? So I only trade after 9:30 a.m. New York time. This is my trading window, and till 11:30. So I have to look for my trades within this period. All right, before 9:30 a.m. I just identify the high time frame direction. Where are we going and where we can go? So I start on the daily time frame, right? Just to get a rough idea where we are. Are we inside a daily fair value gap? Have we taken out some form of like major high and low on the daily time frame? And that pretty much gives me the picture where we can go, but it is not necessary. All you need is a 15-minute time frame direction. If we are going up, you want to trade in that direction because NQ moves in that way. All right, so if we are pushing up, just trade in that direction. I'm going to give you examples. You will understand what I'm talking about. So here is the entire strategy. All right, watch carefully. So let's just go here and put our time period here. So that is 9:30, as you can see, 9:30, right? So let's say that NQ has been going up like that. Maybe it has gone down like that, but overall we are bullish. Now we have the direction, right, that the price is going up. So we do not need to take reversals. We can only look for reversals if we are inside like a 4-hour fair value gap, bearish fair value gap here, right? Or like 1 hour major liquidity. So let's say that there are some equal highs resting around here. So let me just move that here. So you want to stay bullish until that major liquidity is taken out. So your draw liquidity could be session highs and lows as well. So let's say we have taken out the London low, but we have London high. That could be your draw liquidity, or we have taken out, let's say, Asia high for today. So then your draw liquidity could be Asia low. It's pretty simple. Or your draw liquidity could be previous day high, previous day low. Keep it simple. Now after 9:30, right, you are marking out a fair value gap, a bullish fair value gap. Why? Because we are bullish. We are in a bullish trend. We are going up. We have clear draw on liquidity up there. Let's call this Asia high, right? So this, let's say that this is Asia high right here. Now this could be a draw on liquidity. Now let's say that, so the next step is pretty much waiting for price to dip down into that 15-minute fair value gap. And that's where we look for an entry model, and that is the most important part of this video. If you skip any part of this, you will not understand it at all. So on NQ, we dipped into this 15-minute fair value gap, okay? So here's what you have to look at. So next step is you're simply dropping down to 1 minute time frame to frame your trade, frame your idea, right? If you want to take a long from this fair value gap or not. And for that, we need 1 minute confirmation, because you cannot blindly just take a trade from this 15-minute fair value gap, because price can just keep on pushing down. So here is the entry model. Let's say we drop down to 1 minute time frame. Now you have this 1 minute dealing range high and dealing range low. Now within this dealing range, you have to identify a fair value gap on the 1 minute time frame, right? So now let's mark this as our higher time frame fair value gap, and this is a lower time frame fair value gap. Now the next step is, first of all, look for SMT divergence with ES, okay? So if NQ makes a lower low, and on the other hand, ES fails to do so, that is your SMT, okay? Simple. I'm not going to explain SMT again in this video. There are a lot of videos on my channel, or you can watch it on YouTube for absolutely free. No need to pay anyone for this, because it is available for absolutely free. Now we have SMT, but we want to confirm that SMT. The SMT is not confirmed yet. So to do that, we are looking for inversion fair value gap, inverse fair value gap. Simple as that. All right. So let's say price goes up and it closes above this inverse fair value gap. So now this fair value gap becomes inverse fair value gap. But there is a problem, because on the 1 minute, let's say there is a fair value gap, there could be a fair value gap on the 2 minute around here. And price can simply just reverse down from that 2 minute fair value gap, okay? So to navigate through this problem, I have a simple solution for you. So let's say that you are initially on the 1 minute time frame, and you have this 1 minute fair value gap. Now you want to check the higher time frames. So start from 1 minute till 5 minute. 5 minute is your highest time frame, okay? And what I mean by this is, let's say there's a fair value gap on the 1 minute, look on the 2 minute time frame and see if there's a fair value gap on the 2 minute time frame as well within this dealing range, okay? So let's say there is a 2 minute fair value gap somewhere around here. Good. But what if price inverses above it? Well, let's say you go to 3 minute and there's one fair value gap somewhere around here. I'm just giving you an example. So price can reverse from that 3 minute fair value gap, okay? So let's say that you are on the 2 minute time frame right now and you have inversion. And then when you check the 3 minute time frame, which is higher than 2 minute, and there is no fair value gap on the 3 minute, then you are going to stick to 2 minute time frame fair value gap, because that is the highest time frame FVG within this dealing range. So you want to wait for 2 minute inversion, 2 minute candle closure above this. But let's say there was a 3 minute fair value gap here as well, somewhere around here. Then you would wait for a 3 minute inversion. And similarly, you would go until 5. So let's say you go to 4 minute time frame, there's a fair value gap here as well. And the last time frame is 5 minute. And if there's a 5 minute fair value gap, look for a 5 minute inversion. But again, let's say that, let's call this like this 3 minute time frame inversion. So we only have 3 minute, so we have a 1 minute fair value gap, 2 minute fair value gap, and 3 minute fair value gap. And we don't have a 4 minute fair value gap. If you don't have it on the 4 minute, then you stick to 3 minute, the lowest to the one that doesn't have a fair value gap. Now, when price inverses above it, let's say this is on the 3 minute time frame, you are simply going to take a long position. Oh my God, where is it? And you're going to put your stop below the bodies, not the wick, but below the bodies. You want to keep your stop loss small, okay? And as I said before, we have these equal highs up here. That could be your target, but usually I just go for 1 to 2 when my bias is correct, is right, and I'm pretty confident in my draw on liquidity. So yeah, I just go for 1 to 2, even if we have like equal highs up here, because you never know, price can reverse from anywhere. But there are some rules that you have to follow. So first thing first, we are inside the 15-minute fair value gap. We had SMT with ES, and then we inversed above it on the highest time frame fair value gap, right? That is going to be your entry. Now, after your entry, mark out the closest liquidity level, buy side liquidity, right? So over here, we have this high, which is the closest liquidity to our entry. Now, as weird as it may sound, but you always have to go break even whenever this liquidity is taken out. We are trying to protect our capital, and especially when we are trading on lower time frames like 1 minute, 2 minute, 3 minute, you want to be very, very aggressive with your break-even zones, because when trading on like these lower time frames, there's very like small room to error. So you gotta be quick with your break-even zones. Now, I usually take one partial at 1-to-1 risk to reward. So this is going to be my partial level, where I'm going to close around 30% of my position, or even 40%, but I usually go with 30% of my position. And that is going to be your partial. And then your full TP is going to be 1-to-2 risk to reward ratio, right? And you're going to completely close out your position at 1-to-2 risk to reward. And let me just annotate that. Okay, perfect. So then price, if it wants to go and there's momentum, because usually you see momentum after 9:30 a.m., right? And there's high volatility. So there's a very like 50, I wouldn't say like, there's a very low chance that price will close you at a break even, unless you have like a wrong entry or like wrong bias or like a wrong direction. Price will eventually push up like that aggressively if there is draw on liquidity that is yet to be taken out. So in this case, we have Asia high. So you take one partial here, price will consolidate a bit throughout the trade, and then eventually it will hit your full TP. The reason why I go for 1-to-2 is because when price is above 1-to-2, you never know from where price can reverse. It never will, like, it won't always like go towards your draw on liquidity. By now, if you've been trading for so long, you should know that it will not happen. Okay, so pretty much you would do the same if you're looking for a short position, right? I don't need to explain this again. Same stuff, SMT in the bearish 15-minute fair value gap, the trend is bearish. Then we look for highest time from inversion, check 1 minute, 2 minute, 3 minute, 4 minute, and if there's inversion on the 4 minute or 3 minute, you take that inversion. And if there's only fair value gap on the 1 minute, there's no fair value gap on the 2 minute, then just stick to 1 minute time frame. All right, so that is pretty much the strategy. Now I'm going to give you guys some examples. Do not skip these examples, because these are the examples that are going to teach you a lot about this model. This is just a depiction of what I use, but the real stuff is in the examples, so keep watching. All right, so here is example number 1, and pretty much you can see that we are bullish overall. So I was expecting higher prices this day, on this day. This is Tuesday. And notice what we got here. So we had this fair value gap in the discount, the 15-minute fair value gap. And we're always trading after 9:30. So we're going to mark that out as well. So that is our, so market opens and we leave behind these equal highs up here. That could have been your draw on liquidity. Now price tapped into this fair value gap. So let's go down to 1 minute time frame to frame our trade. Now, as I said in my previous videos, SMT is not usually essential, but it always like kind of improves your win rate. Now, I'm not sure if you got SMT here or not. I'm not going back and checking ES, but now notice this carefully, okay? So we are on the 1 minute time frame. So the first thing, mark out the dealing range, okay? So we have dealing range high and the dealing range low. Now, start moving to the higher time frame. Check if there's a fair value gap on the 2 minute. And yes, we have 2 minute fair value gaps in this dealing range. Check the 3 minute time frame. Do we have it? Yes, we have it around here. Now let's go to the 4 minute time frame. But notice one thing. When we go to the 4 minute time frame, we do have a 4 minute fair value gap, but the dealing range is not there anymore. Okay, so we had a high over here, but it's not there anymore, which means we just go back to 3 minute. Even though we have a fair value gap on the 4 minute, but we need to have a dealing range. We need to have a fair value gap within the dealing range. But since there's no dealing range on the 4 minute, we just go back to 3 minute time frame. Now we had this fair value gap, price inverses above it. That would have been your long position. Your stop loss would have gone probably below the bodies here, or just to be conservative, just put it somewhere around here. Now, this is the closest liquidity level after your entry. So that is your entry. Look to the left. We have buy side here. Price reaches that level. You go break even. Okay, this is your entry around here. Then notice these equal highs up here. This could have been your full TP. Or usually, when I said before earlier, you go for 1-to-2 risk to reward. But eventually it did go up here. Let's move on to the next example. All right, so here is the trade that I took today live in front of the members. So initially my bias was bullish. So if I start on the daily time frame, you can see that we were kind of inside this daily fair value gap. So I was expecting this high to be taken out. But going on to the 15-minute time frame, you can see that after the market opened, which was around here. So let me go somewhere. Okay. So after 9:30, I couldn't get any opportunity to get into trade because we had this fair value gap on the 15-minute, but price never reached that. But then I noticed that we might be reversing here because we had this sharp market structure shift here, and then we left behind this fair value gap around here, just above all the buy side liquidity that we had. So when price tapped into this level, I was kind of like looking into the charts, and then we took 1L initially, and that was on the 30-second. I don't do it. I'm not going to teach you the 30-second because it is very aggressive, and I don't usually do that. But I was pretty confident that we're going to reverse from here. So if we go on to the 30 seconds time frame here, let me show you because transparency is important. No one is going to show you losses, but let me go here and turn on the executions. It's not showing right now. I'm not quite sure why. I have the TraderWeight account open, but anyways, when price dipped into that 15-minute fair value gap, we had this inversion here. Okay, honestly, it was M and Q. So let me go here, and now it's going to show you the executions, I believe. All right, perfect. So now you can see that I was on the M and Q. I didn't check NQ because usually you should do that. But when we closed below this, we had this 30-second inversion. There was no dealing range on the 1 minute. So I took a short position, but then we got stopped out over here. But then eventually, let me just remove all of this. Then I went to the 1 minute time frame, and I saw that we had this 1 minute fair value gap inside this dealing range, right? So I marked that out, and then I slowly went, and then this was the dealing range low, and this was the dealing range high, right? So I then went down to 2 minute, went up to 2 minute to see if we have a fair value gap. But we did have a fair value gap on the 2 minute, but you can see here the dealing range is not there anymore. This was a low on the 1 minute, but it is not on the 2 minutes. So we're just gonna go back to 1 minute time frame. So going over here, we had clear sell side liquidity down there, equal lows, and pretty much when price inversed below it, that was my entry. I took one partial here, and then I closed out at 1 to 2 risk to reward. So that was a W day, and yeah, simple. You know, if I'm teaching, it doesn't mean that I don't take losses. You know, a lot of these gurus they tell you that they have like this 100% win rate, but even though I had a correct like narrative, right after my buys being bullish, this was kind of like aggressive entry. In this case, I should have waited for like 1 minute closure, but it was just so aggressive, and that's something that I do when I'm pretty confident about my narrative, but it just didn't play out simply. But then losses are part of the game. We took this and we recovered and made a lot of money. Let's move on to the last example now. All right, so here is the last example. So you can see that we've been kind of pushing down here. We've been kind of consolidating here, but if I go onto the daily time frame, right, you can see that we were overall bullish. And whenever we are like all times high, you always want to be trading to the upside because you never know when price is going to reverse. So you're going to keep on taking losses if you keep trying to chase reversals, if that makes sense. So now going on to the 15-minute time frame, bias was bullish. And then we had this fair value gap on the 15-minute. So now I'm going to drop you a secret sauce. Instead of looking at 15-minute fair value gaps, you can also look at 5-minute fair value gaps. And also you can look at session highs and session lows liquidity sweep. So if you sweep out London low with like SMT, and if there's no fair value gap, you can take a long from there as well. Fair value gap is not necessary. But again, if there's a 15-minute fair value gap, that is going to increase your probabilities. So we have buy side liquidity over here. So now let's just drop down to 1 minute time frame. Actually, this isn't a buy side liquidity. Let's just go somewhere around here, and we have buy side liquidity around here. Sorry for that. So now let's drop down to 1 minute time frame, see if we have fair value gaps and stuff. So from this dealing range high to around this dealing range low, right? Let's see. Let's check 2-minute time frame. Then let's check the 3-minute time frame. So you can see on the 3-minute there is no dealing range, so we go back to 2-minute time frame, and we want to mark out the fair value gap. So pretty much that would have been your entry. Stops below the bodies, and you would go for 1 to 2. Honestly, I would just close my trade out at that liquidity level. In that case, I wouldn't just chase 1 to 2, but eventually it was hit. So this would have been your break-even zone. It didn't close you out at break-even. Don't worry about that. 1 to 1 partial. And then pretty much 1 to 2 is where you take your profits. So again, fair value gap, sometimes not necessary. All you have to do is look for liquidity sweeps of London high, London low, or Asia low, Asia high. And also price can also tap into 5-minute and sometimes even like on the 4-hour fair value gap. So it's all about like high time frame key levels and then looking for your confirmations, because price moves from external to internal range liquidity, sweeps out highs, taps into fair value gaps, and then pushes up. So that's going to be it for today's video, and I'll see you guys in the next one.